Marsh, ticker MRSH, is one of the world's leading insurance brokerage and risk advisory companies. The investment thesis is based on recurring revenue, strong margins, high free cash flow, acquisitions, share buybacks, dividend growth, and increasing demand for sophisticated risk management services. At around $184 per share, MRSH is not a deep value stock, but it can be attractive as a long-term quality compounder. My 12 to 24-month framework is bear, $170 to $190, base, $215 to $230, and bull, $245 to $250 plus dollars. MRSH operates in a business with significant competitive advantages. Insurance brokerage requires deep industry relationships, expertise, data, scale, and trust, creating relatively high barriers to entry. Marsh benefits from its global footprint and diversified client base. Businesses increasingly need protection against cyber threats, climate-related risks, geopolitical uncertainty, supply chain disruptions, and regulatory changes, supporting long-term demand for Marsh's services. Revenue growth is one of the most important factors for MRSH. The company can grow through organic revenue expansion, insurance pricing, new clients, higher risk complexity, and acquisitions. Recent growth has moderated, but the long-term opportunity remains attractive. My base case framework assumes approximately 5 to 7% annual revenue growth through 2026 and 2027, potentially taking annual revenue toward the $31 to $32 billion area by 2027. Earnings per share growth is even more important than revenue growth because Marsh can combine revenue expansion with margin improvement, acquisitions, and share repurchases. My framework assumes approximately $10.7 to $11.0 EPS in 2026 and approximately $11.5 to $12.2 EPS in 2027. If Marsh reaches the upper end of this range, the probability of a $250 share price becomes significantly stronger. MRSH has an attractive profitability profile compared with many traditional financial companies. Its business model is relatively asset-light and produces strong operating margins and cash flow. The company's ability to convert revenue into operating income and free cash flow is a major reason investors have historically been willing to pay a premium valuation for the stock. Free cash flow is one of MRSH's strongest fundamental characteristics. Strong cash generation gives management flexibility to fund acquisitions, pay dividends, repurchase shares, and manage debt. At roughly $184 per share, the company's free cash flow generation provides a meaningful foundation for the investment thesis. Continued FCF growth would support both shareholder returns and long-term EPS growth. The dividend is not the main reason to own MRSH, but it adds an important shareholder return component. The company pays roughly $3.96 per share annually based on the recent dividend rate, producing a yield of around 2% at approximately $184. Marsh has also maintained a long record of dividend increases. If earnings and free cash flow continue growing, dividend growth can remain an important part of total shareholder return. Share repurchases can become another major EPS catalyst. When Marsh buys back shares while earnings continue increasing, the same amount of corporate earnings is distributed across fewer shares. This can accelerate EPS growth even when total revenue growth is only moderate. Continued buybacks therefore support the long-term bull case. Acquisitions are an important part of Marsh's growth strategy. The company can use its scale and cash generation to acquire businesses that expand its geographic presence, customer base, expertise, and advisory capabilities. Successful acquisitions can increase revenue and create cost synergies, although investors should monitor acquisition prices, integration risks, and debt levels. Artificial intelligence could become a meaningful productivity catalyst for Marsh. Insurance brokerage and consulting involve large amounts of data, documentation, research, analysis, and administrative work, creating opportunities for automation and improved employee productivity. Marsh's Thrive program is also designed to improve efficiency, with management targeting approximately $400 million of savings over 3 years. Successful execution could support margin expansion and EPS growth. The balance sheet is one area investors should monitor carefully. MRSH carries substantial debt relative to its cash balance. However, the company also operates a highly cash-generative and recurring revenue business, which gives it significant capacity to service its obligations. I therefore view the balance sheet as a manageable risk rather than a fundamental investment breaker, assuming cash flow remains strong. At approximately $184 per share, MRSH trades at a premium earnings multiple compared with many traditional financial companies. This premium is justified by the company's strong margins, recurring revenue, cash generation, competitive advantages, and long-term growth potential. However, the valuation also means investors have less room for disappointment. If growth slows significantly, multiple compression could put pressure on the share price. Wall Street's current expectations are more conservative than the $250 bull case. Recent consensus estimates place the average analyst target around the low 200s, with higher targets reaching into the 230s. Therefore, $250 should be considered an aggressive bull case scenario rather than the consensus forecast. To reach $250, Marsh would likely need stronger than expected earnings growth and continued investor confidence in its premium valuation. In my bear case, MRSH trades around $170 to $190. This scenario assumes slower organic growth, weaker insurance pricing, pressure from lower interest rates, limited margin expansion, and some valuation compression. Because MRSH already trades at a premium multiple, disappointing earnings could cause investors to reduce the valuation multiple quickly. My base case is $215 to $230 over the next 12 to 24 months. This scenario assumes approximately 5 to 6% revenue growth, continued margin improvement, EPS approaching approximately $11.5 to $12, continued capital returns, and a valuation multiple around 19 to 20 times earnings. Under these assumptions, MRSH can deliver a respectable return while maintaining its position as a high-quality compounder. The $250 bull case requires several things to go right. Revenue growth needs to move towards 6 to 7% or higher. Thrive needs to produce meaningful cost savings, acquisitions need to contribute effectively, share buybacks need to continue, and EPS needs to approach or exceed approximately $12. If investors continue assigning MRSH a premium multiple of roughly 20 to 21 times earnings, a valuation around $245 to $250+ becomes achievable. The major risks include slower insurance market growth, lower insurance and reinsurance pricing, declining interest rates reducing fiduciary income, high valuation, substantial debt, acquisition execution risk, and potential disruption from technology. The biggest near-term risk is valuation. MRSH is a high-quality business, but investors are already paying for a significant portion of that quality. My framework is bear, $170 to $190, base, $215 to $230, and bull, $245 to $250+. The base case represents a reasonable outcome if Marsh delivers consistent mid-single-digit revenue growth and high single-digit EPS growth. The bull case requires stronger operating execution and continued premium valuation. The $250 target is therefore achievable, but it should be viewed as an optimistic scenario rather than a guaranteed outcome. I would rate MRSH approximately 8.3 out of 10 overall. Business quality is 9 out of 10, profitability 9 out of 10, free cash flow 9 out of 10, dividend quality 8.5 out of 10, long-term growth 8.5 out of 10, balance sheet 7 out of 10, and valuation 6.5 out of 10. The company's biggest strengths are its competitive position, recurring cash flow, profitability, and ability to compound earnings. MRSH is best viewed as a high-quality long-term compounder rather than a cheap financial stock. At around $184, I would consider it more attractive on pullbacks than after a sharp rally. My 12 to 24 month framework is bear $170 to $190, base $215 to $230, and bull $245 to $250 plus dollars. The central investment thesis is that if Marsh converts mid-single-digit revenue growth into high single-digit EPS growth while expanding margins and returning capital to shareholders, the $250 bull case target becomes realistic. Overall, my view is buy on weakness, hold at fair value.